Anyway, welcome back. Let's kick on with the second half of the seminar, and we have a presentation from Lee McCormack, who is Executive Director of OTC Clearing at Nomura, and he'll be talking to us about central clearing and all the associated paraphernalia. Mr. McCormack, please.
Thank you. Thank you very much for the invitation to speak and for the introduction from Murad. You might not believe it, but I'm quite honoured to be here today. It's a great room. I brush my hair especially. Why is that funny? Which one? Thank you. Back in the day, a little bit about me. My name is Lee McCormack. I work in the OTC derivatives clearing team at Nomura, so I'm building and selling our derivatives clearing service, so giving access to those people who are not direct members of a clearinghouse, access to clearinghouses such as LCH, Eurex, etc., etc. I started my career at the LCH in risk management, where I read a lot of Murad's books, actually, so it's an honour to be introduced by him. And I guess one of the reasons why I've been asked to speak today is that I do have a little bit of sort of history in terms of clearing. So after I left the LCH, I was part of the default management group still. When I was at UBS, and I was seconded back to the LCH just for a week or so to help close out the Lehman's position. So I was in the room when the stuff hit the fan. So hedging and closing out and watching the auction process of how it all worked. So for those of you who like the advent of clearing rules and now been mandated by the G20, I guess I have a small part to play in that, making it a relative success, how it went at Lehman's. So that's a little bit about me and why I'm here. I would like to say as well, really, before I start, it's quite good to be at a risk management conference talking about clearing. I feel as though I can finally be myself and come out and say the crisis has been a good thing for me. You know, my career has gone through the roof, bearing in mind everything's about clearing now. And I guess I'm in kindred spirit company, because as risk managers, you guys must be enjoying it a little bit more. All we need now are the compliance folks as well, and we can have a proper party. Okay, so please feel free to stop me all the way through. I will try and leave some time at the end for questions, but please stick your hand up if there's anything that's unclear, or if you want to make a point or even heckle. So starting at the start, what is clearing, why we're here? So the G20 mandated that derivatives are evil and should be traded on exchanges, processed through central counterparties, and reported through trade repositories, which is the best idea, but obviously implemented badly. The thing that I always find funny about this should happen by the end of 2012 at the latest. So the house that I bought with my new pay rise from knowing about clearing, I should have leveraged up a little bit more, but I didn't. So the fact is, the timelines being that obviously the US started clearing 2013, implemented in various phases for clients, should I say. Japan actually starts next in December, which captures we think approximately 30 largest clients. And then finally we got some clarity, or further clarity the other day from ESMA in Europe, that interest rate products will start, I guess the ink should be dry by February next year, and then client clearing, those people in category 2 and 3 and 4, certainly will kick off by, let's say, February 2016. I think that's the current estimate, but we're getting the concentric circles are getting smaller. Okay, so that's the slide I just talked about. Interestingly enough, that there are other regions where we thought that mandatory clearing would kick in for clients in Hong Kong, Singapore, and Australia, for example. But I think the regulators there have taken a little bit more of a wait-and-see approach to see whether they need to mandate that clients put their trades through central clearing as well, or whether there will be voluntary adoption into the market. So there is a chance that pricing moves such that it's economically cheaper to clear a trade than it is to keep it bilateral. And I think the regulators are thinking, hopefully, that will take in the majority of the trades that they think should be into clearing. So for those of you who have not been following it, lucky you, but this is a basic overflow of how clearing works. So trading, I guess, is ambivalent, although according to the G20 statements, trading should now be electronic where possible for standardized derivatives. So the client will trade with the executing broker. They will drop the trade somehow through an affirmation platform such as MarketWire or Bloomberg or some electronic messaging service is the key to take away into the clearinghouse, whereby the clearing broker, which is me, will get a message from the clearinghouse and accept or reject the trade according to risk limits, whether it be initial margin or notional or whatever we agree when we sign you up. I think the key thing to really take from that is the impact that it has on the way we trade. So back on this first page, previously the client would face the executing broker for the duration of the derivative. So a 20-year interest rate swap, you would have counterparty risk to that original executing broker for 20 years, and the same the other way on the client. When you drop this thing into a clearinghouse, there is no legal relationship between the client and the executing broker. There's no direct risk relationship between the clients and the executing broker. So it changes the trading dynamic. So what was a bundled service before, when you'd sign your ISDAs and CSA documentation, you would get your trading price, you'd get in effect your clearing and settlement price, and associated bundled financing, which happens within an ISDA and CSA, you'd get that all in one place. And so quite understandably, clients reacted to that and would go with the too big to fail banks. You would trade with those guys because there's no way Lehman's are going bust, are there? So post-regulations, what that's doing, it's shifting these things out into discrete packages. You can bundle them together if you like. And if you're from Hull, thing bundling sounds pretty funny, even to me. But these things are separate, so you can shop around for the cheapest trading price. You can shop around for the best, cheapest, however you grade your clearing and settlement, and also shop around for any associated financing. You can choose to bring them all back together again, so if you want to go and get your collateral transformation and all of the associated financing services from your clearing broker, you can do that, but you're no longer forced to do that. It's not implicit in the way that these products are traded. And speaking selfishly from Nomura, we're pretty keen on that. We weren't one of the big bulge bracket banks. Credit rating used to be an issue, it's becoming increasingly less so, and the number of ISDAs we had in place was not as significant as some of our competitors. So this change in market dynamic is warmly welcomed at Nomura, and we can't wait for it to happen. I should add, by the way, I also saw that Stephen gave you a presentation before. Other investment banks are available as well. Okay, so what are the concepts around the margin side of clearing? I presume some of you will know this, but the fact is that the clearinghouses will collect initial margin from both sides of the trade. So they will assess the risk on a portfolio basis. They will look at the initial margin. They'll do an initial margin calculation and say, okay, you guys have just traded this trade. You owe me X millions of initial margin. That's initial margin which is collected by the clearinghouse. And then the clearing broker will go away and collect that from the client. But that sits and is locked up within the clearinghouse. The other side of that is the variation margin, which is a daily mark-to-market, it's P&L, it's a pass-through. Variation margin is collected in a currency, cash currency in the underlying contract. So irrespective of if you have a dollar CSA with the person you've just traded with, if you're trading a euro interest rate swap and you pop that into a clearinghouse, then the daily variation margin will be collected in euros, and that's a pass-through. So there's the reason why I highlight the fact that one is collected and one is passed through, that has the impact upon what the clearinghouse will accept as margin. So on this slide here, let's finish off on this one. So the initial and variation margin are part of the default management waterfall, or the way that the clearinghouses protect themselves. That's why I've included that slide in there there is a whole list of things that the clearinghouse has at its disposal to protect itself in the event of a default. The stuff below the line is when people are starting to default and lose money, but there are protections on the way in, such as membership criteria, which have changed quite dramatically in recent years, mainly thanks to legislation coming out of the CFTC. It's worthwhile mentioning, certainly in the default that I was involved with at LCH, the initial margin of Lehman Brothers, I think only 1/3 of it was used in the closeout. So the margin calculations are very conservative. Generally speaking, they're designed to withstand a significant market stress. So there's a collateral and a margin impact on clients and everyone who's using clearing. Clearinghouses will only accept certain types of collateral as margin. Just listening about that. Generally, it's cash or securities, and securities being G7 government bonds, for example. So it's a highly they actually have it as highly rated collateral, but I would suggest it's probably not the rating that's the main driver of their collateral concerns. It's liquidity. I guess you can, in the event of a default, they need to carry on paying the variation margin out to the other side. So back in our scenario here that Lehman's has defaulted as the executing broker, there is a client or other people on the other side who are still expecting to receive their variation margin payment. How does the clearinghouse generate that cash variation margin? It sells some of these bonds that it's accepted as initial margin collateral until it can find a substitute person on the other side to step in. Okay, so how much margin is required? As I said, the CCPs have slightly different models. There are global regulatory technical standards, basically talking about that the initial margin can only be floored at a certain level. So there isn't this concern around race to the bottom, direct race to the bottom on risk management standards anymore. Generally, that's I think those global principles are it's a 5-day closeout period with a 99% confidence interval. Okay, so on here we've just something that we produce every week is in terms of just understanding the initial margin requirements for the different clearinghouses. Well, so you can digest some of those figures, but one thing that I think that I've seen in my experience, so if we look at, let's say, a 30-year interest rate swap, 12.73% at LCH versus 8.5%, 8.25% at the CME. Apologies to Eurex, those figures are not on there. Ricky's got them in his bag. Ricky's on the next panel, so he can talk about that in a moment, and you can stare at his nice new goatee beard. So one thing I've observed thus far, I've not seen clients choosing clearinghouses based off initial margin purely yet, outright. It's not been a significant driver. To date, clients have just wanted to really get compliance. They're more scared of the regulators than they are by the treasurers or the finance guys and the shareholders at the moment. I think that will come. I think clients, once they are very comfortable and have been using clearing for an extended period of time, then they will try and drive down efficiencies and costs. So, I get invited to speak at a lot of collateral management conferences talking about optimization, and I've been doing that for 5 years, and it's good fun, but we haven't really seen much change yet, and I think that's because clients are not really in the zone of optimizing and reducing and becoming more efficient. They just want to get compliant. So it also leads to the other point of there are market statistics about which clearinghouses have how much volume and notional and open interest. I have a pension at the LCH still, and I would love to see if the incumbent open interest that LCH have actually means anything. Is there a different trading price because there's a lot of liquidity in LCH versus less liquidity at the moment at other clearinghouses such as Eurex or CME? We're not seeing too much of that at the moment, but these are sort of the interesting discussions that we have on the margins of the clearing conferences. That's not particularly interesting, is it? Okay, so what can you do? So clients can minimize their margin calls. That you can have a race to the bottom on risk standards between the CCPs. We don't see that directly. We do see that different CCPs will have different features of their service. Some CCPs apply a 7-day close-up period for clients. They have a 2-day buffer to try and allow, let's say, that you were clearing with Lehman as your clearing member. Some CCPs have a 2-day buffer added onto the margin requirement to try and allow you 2 days to find a secondary or backup clearing broker or port your position to somewhere else. You can lower your outright initial margin by cross-product margining. So Eurex and a CME, for example, I'd say are pioneering the ability to cross-margin your open interest or your positions in interest rate swaps versus their incumbent futures liquidity. can you accept a wider range of collateral as initial margin? If it's cheaper for you to post corporate bonds, or if you're a corporate bond fund, you're not going to be sitting around on cash or other eligible securities at CCP, will you be able to post those bonds to a CCP directly as initial margin, or are you going to go and find some financing services to upgrade that ineligible collateral for eligible collateral? There's a bit of an arms race as well with the CCPs about expanding their product ranges. So if you're a hedge fund who's trading swaptions versus swaps, for example, swaps, vanilla swaps are clearable and are mandated for clearing in some regions versus swaptions which are not ready for clearing. So some clearinghouses are out there looking to launch swaptions as the next product they accept into clearing. Other clearinghouses are focusing on inflation products because they're targeting a slightly different client base, mainly for asset managers or pension funds who would do more inflation business versus swaptions who tend to reside with some of the hedge fund. The other way you can reduce your margin and the liabilities associated with that is clear efficiently. CCPs apply a liquidity multiplier, basically. So if you have all of your business with one clearing member, the CCP will look at that business, that portfolio. They assume it takes 5 days to close out your position, but they also do tests on how much liquidity is in the market over a stressed 5-day period. So your position could be twice as big as what they think they can get away or trade within a 5-day closeout period. So they'll charge you 2 times margin. In order to avoid paying 2 times margin, the way around that is to open up a relationship with another clearing member, because the clearing houses are facing the clearing members. So they're only concerned about your risk if your clearing member was the default. So by spreading your risk across multiple clearing members and doing it in a smart way, rather than putting all your pays in one clearing member and all your receives in another, by having a relatively balanced portfolio across clearing members, you can reduce your margin requirements as well. Okay, one thing I wanted to put in here is this concept of front-loading. This is a very European, it is a European only issue. It was in the EMEA legislation. Front-loading is a concept that I don't think many people really like. Maybe I explain a little bit about sort of where it is, and most conversations that you have or arguments about the rules tend to be said on where do you set the dial. As a sell-side provider, I would maybe want it at one end of the spectrum, and as a buy side, you guys might want it at the other end of the spectrum, and it's just a question about where it's set as to who gets the most benefit. Nobody liked front loading, and nobody still does like front loading. I can't quite understand how it managed to survive within the legislation, but it did. The fact is, it's here, and what it means is that originally in the first level of the European text, front loading applied to mandated products from the date that a clearinghouse was authorized under the new EMEA rules. That means as of mid-March this year, when NASDAQ were authorized for clearing European interest rate swaps, that front-loading theoretically started applying. But we still didn't know yet if European interest rate swaps would be mandated. It was only last week that they finalized their version of the proposal for the rules. So what the regulators did, they kind of got rid of the uncertain trade population period and said, okay, we'll only let it apply to trades once we know which trades are going to be mandated for clearing. And you might think, okay, that's fine, you've done us a bit of a favor, but there are still quite a lot of uncertainty around front loading. I'm not sure if it was discussed on the last panel or not. Ricky's giving me the nod, but it was. So there are, you will be aware there are still pricing uncertainties and actually significant legal uncertainties. So if you're a client, you trade a mandated for clearing product within the front-loading period. What if your clearing member doesn't accept it? What if you've breached your margin limits? What if your clearing member's defaulted? What if they've turned you off? So there's going to have to some sort of legal fallback provisions as well with regard to front-loading. It's not fun. Okay, I guess the final part of my presentation is talking about the capital side and the capital considerations within clearing. Generally speaking, capital, and more specifically, I think it's the leverage ratio, is the things that are worrying clearing members. So access to clearing is not something that is being done on a retail basis. It's not like the old futures model in Europe, where the more volume put in, the more revenue you could generate and the more profits you all made from the business. Because of the requirements around capital, so as a clearing broker, I have capital exposure potentially to the CCP, but probably not, because I'm not going to guarantee the CCP's performance to you as my client, but I still have capital exposure to you as to the client. Now, I can reduce my exposure by using your initial margin, and if for whatever reason your initial margin isn't enough, then we can do a calculation and charge you more initial margin, which is nice. So there's ways round the costs of the capital side of it, but the capital is increasing, and it is a costly thing to be a member of a clearinghouse. The main capital concerns that we have as a direct member of a clearinghouse is around the funding costs and also the capital exposure of our default fund to the CCP, because that is at risk in the event of another Lehman's default. They can burn through the initial margin and then they can eventually hit my default fund. As I said, the leverage ratio is the main area of concern for most clearing members. In this calculation back here, the exposure side of it, my leverage ratio calculation when I'm facing the CCP, on your behalf, by the way, but if I'm facing the CCP, that trade is not counted towards my leverage ratio. The trade I have facing a client, when I'm the clearing broker, does count towards my leverage ratio. So and that is there's a tweak that did change that, so it was both sides, which was utterly crazy. But it's the leverage ratio, which is the thing that's operating I guess it's like a silent buffer or a silent brake on the market. So clearing brokers are not offering clearing to every single client out there. It's not a retail model. It's not more people through the door, the more money you make. Because of the leverage ratio constraint, clearing is something which is increasingly seen as a finite resource, which is only offered to clearing members' target clients. And we all have different ways of determining who our target clients are. But we're seeing a lot of clearing members are already full, and clients are starting to either get really quite horrible pricing, and certainly directional asset managers, who would be the biggest consumers of this leverage ratio resource. Those guys who were once given extremely competitive pricing are kind of being repriced across the street. So it's going to be an interesting one. I think the regulators are concerned, specifically in Europe, about getting clients, making sure there's enough access to clearing. So there's a shift in the dynamics between supply of OTC clearing and demand. Supply is coming down. We've seen a few people publicly pull out of offering this service recently, at the same time where client demand is starting to go up with the regulations hitting. Okay, more leverage ratio stuff. Please, any questions?
Do you mean that was the best slide? Thanks very much, Mr. Cormack. I appreciate that. Any questions for him from the floor? It's two, in fact.
Thank you. Hi. You mentioned that if a client to clear the trade, big trade, through different clearing members to avoid the double count of the initial margin. But if client choose different clearing members, is there any additional cost, for them to choose two clearing members? So eventually they need to pay twice.
Agreed. Yes, that is. You will be paying two clearing members' fees. You're not going to pay any extra cost at the clearinghouse, unless the clearinghouse charges you for having an account open there with a clearing member. Some of them do. Yes, that is the cost. In my experience, the main cost, certainly for someone who is large enough to need to have multiple clearing brokers, the main cost for those guys is the funding of the initial margin and the margin costs. It's not going to be my fees that's going to be the thing that's really going to be the painful side of it. Or the fact is, this new world is more expensive. We're hearing this all the time. The capital costs are going up. Costs are going up for processing derivatives. I think it's a very conscious policy decision by the regulators. There was too much cheap money flushing around. There's too much derivatives. They didn't like it. But yes, it will be more expensive.
Sorry, and the second question is, in the slide, somewhere in the slide, you mentioned the cross-product margining. So basically, I assume that if you have a different asset class clearing at the same clearing house, you can get the benefit of somehow correlation or benefit in your capital requirement. But my understanding is that from Basel side, cross-product netting is not allowed in capital treatment. Is there implied inconsistency between the CCP capital and the Basel capital side?
Yeah, the cross-product margining is not between significantly different netting sets. It's between interest rate futures and interest rate swaps.
Right.
So it's within the same asset class, however, whatever you're defining. So it's futures versus swaps within the same interest rate product. So it is consistent from that point of view.
Okay, so you are saying the cross-product margin you mentioned is under the same netting set with the same type of asset class that you can cross-product margin them?
At a CCP, those CCPs who are doing it. So your ex, Ricky, is up next. He can talk to you about this all day long, and I'm sure he will. But yes, absolutely. So the